In December of 2019, physicians in the Chinese city of Wuhan began documenting clusters of pneumonia cases that did not match any known respiratory illness. Hospitals isolated patients while laboratories raced to identify the pathogen. Within weeks, researchers confirmed it was a novel coronavirus, genetically related to SARS. By January, the story had spread far beyond regional bulletins. Chinese authorities locked down entire metropolitan areas. International airports began screening passengers. Public health agencies warned that human-to-human transmission was accelerating. On January 30th, the World Health Organization declared the outbreak a global public health emergency. Markets barely flinched. Equities dipped for several sessions and then recovered. Oil wobbled. Volatility rose modestly and then faded. Investors treated the situation as a regional shock, serious perhaps, but unlikely to derail the global expansion that had defined the previous decade. February changed that calculation. Large outbreaks emerged in South Korea, Iran, and northern Italy. Hospitals in Lombardy filled so quickly that military convoys were eventually used to transport the dead. Governments suspended large gatherings. Conferences were canceled. Airlines began trimming schedules. Multinational corporations warned that factory closures in Asia were disrupting supply chains. Every morning brought larger numbers. Confirmed cases, fatalities, entire cities under movement restrictions. On March 11th, the World Health Organization formally declared COVID-19 a pandemic. The word cut through markets with a bluntness that earnings misses and geopolitical disputes rarely achieve. Within hours, universities closed campuses. Professional sports leagues suspended seasons. Office towers emptied as companies ordered staff to work from home. Restaurants went dark. Streets in major capitals fell unnervingly quiet. For the first time since the financial crisis, the threat confronting investors was not financial in origin. It was biological, and governments were responding by shutting down the physical economy. Long before U.S. markets reached their lows, the plumbing of global finance had already begun to strain. In late February, airline stocks sagged. Cruise operators collapsed. Energy shares drifted lower as travel demand projections were revised downward. Credit spreads widened quietly, the first signal that bond investors were beginning to reassess corporate solvency. On Sunday evenings, futures traders refreshed screens as Asian markets opened. Index contracts slid lower in steady, deliberate steps. Social media feeds filled with charts tracking hospital admissions and flight cancellations. Macro accounts posted satellite images of ports operating below capacity. Inside hedge fund offices and asset management towers, risk teams ran stress scenarios that only weeks earlier would have seemed absurd. What if borders closed? What if offices emptied? What if consumers stopped leaving home altogether? Most managers cut exposure. Few cut enough. Then came oil. In early March, OPEC and Russia failed to agree on production cuts, unleashing a price war that sent crude tumbling in double-digit percentages overnight. Energy equities cratered. High-yield bond spreads jumped. Currency markets reacted violently. What had started as a public health crisis was now colliding with geopolitics and commodity markets. The shock was widening. On March 9th, U.S. stocks opened sharply lower and fell so fast that automatic trading halts, circuit breakers designed after the 1987 crash, were triggered for the first time in decades. 15 minutes. Markets froze. Television anchors filled airtime while investors stared at static screens. When trading resumed, selling accelerated. Volatility surged to levels unseen since 2008. Options desks scrambled to hedge positions as dealers sold futures to manage exposure, pushing indexes lower still. The feedback loop between derivatives markets and underlying stocks intensified. Treasury securities, normally the ultimate refuge during panic, began behaving strangely. Prices gapped. Bid-ask spreads widened. Funding desks whispered about strain in repo markets, where banks and hedge funds borrow cash overnight using bonds as collateral. Cash suddenly mattered. A lot. On the evening of March 3rd, the Federal Reserve made a rare, unscheduled move, slashing interest rates by 0.5 percentage point. The intention was stabilizing. The reaction was not. Futures markets slid further. Traders interpreted the emergency action as confirmation that policymakers saw something alarming beneath the surface. Asian markets opened in free fall. Europe followed. Overnight, U.S. equity futures hit their downside limits, unable to trade lower. By the time New York woke up, screens across the world glowed red. As markets convulsed, margin calls spread through the system. Prime brokers demanded more collateral from hedge funds. Retail traders received automated warnings that leverage had been reduced. Prop trading firms tightened risk limits mid-session. Clearinghouses raised margin requirements to protect themselves from defaults. Across asset classes, correlations snapped. The U.S. dollar surged as global borrowers scrambled for funding. Emerging market currencies sank. Gold swung violently. Bitcoin plunged alongside equities as forced liquidations rippled through leveraged crypto positions. Screenshots flooded social platforms. Accounts wiped out. Liquidations executed at terrible prices. Years of gains erased in hours. Meanwhile, even the Treasury market began to seize. Some bond ETFs drifted away from the value of the securities they supposedly tracked. Market makers widened spreads dramatically. For a brief period, the safest asset in the world struggled to trade smoothly. The plumbing of finance, the quiet machinery that allows trillions of dollars to change hands every day, was groaning. Over the second weekend of March, governments escalated their response. Borders closed, cities locked down, public gatherings were banned, schools and universities shuttered, professional sports leagues suspended seasons. Large parts of the global economy simply stopped. Markets tried to price that reality in real time. They failed. Prices collapsed, then rebounded, then collapsed again. Short covering rallies smashed into forced selling. Hedge funds dumped liquid winners to meet margin calls. Corporate bond markets froze until the Fed promised to step in directly. When policymakers finally unveiled the full scale of their response, rates cut to zero, unlimited asset purchases, emergency lending facilities, dollar swap lines with foreign central banks, the objective was clear: flood the system with liquidity, prevent a financial crisis on top of a public health disaster. By late March, selling pressure finally slowed, not because fear had vanished, because intervention overwhelmed it. Bid-ask spreads narrowed, futures stabilized, funding markets relaxed. The tape stopped screaming. When analysts looked back, the statistics stunned even veterans. The fastest bear market in history. Trillions erased in weeks. Volatility records shattered. Oil near $20 a barrel. Unemployment claims surging at a pace never before recorded. Entire industries frozen. Retail trading would surge later, fueled by stimulus checks and commission-free apps. A new generation of market participants was forged in extreme conditions. Institutional desks rewrote risk manuals. Stress tests expanded. Liquidity assumptions were torn up and rebuilt. Emergency calendars became permanent features on trading floors. Across spare bedrooms, kitchen tables, and makeshift home offices turned trading stations, people stared at charts that no longer obeyed familiar rules. Here's the tonic. Markets rarely fall the way movies portray them. They fracture across assets, across time zones, across systems that go unnoticed until they falter. In March of 2020, it was not one crash. It was hundreds, happening simultaneously. Stocks, oil, foreign exchange, crypto, credit, treasuries. Each market screaming its own version of the same message. The world was shutting down, and finance was racing to keep up. When people remember that month, they talk about the drop, the rebound, the charts, the astonishing speed. Traders remember something else. The night's futures sat locked at limit. The silence before circuit breakers lifted. The margin emails. The feeling that the screen had grown larger than them. Because that was the month markets stopped behaving like markets and started behaving like emergency systems.